Let me start this session with a puzzle. Over the last 30 years, our access to data has improved dramatically. 30 years ago, to value a company, I needed to go find an annual report, probably physically, perhaps forget about email, write to the company to give me more information. But I was stuck with very limited data. Today, I can download the data in seconds for thousands of companies. We also have much better models at our disposal. I don't need a mainframe to run a Monte Carlo simulation. I can run it from my PC. So we have more data and better models. Our valuations should be getting better, right? But they aren't. So let's think about the biggest enemy in valuation. It's not that people don't know valuation, that they can't build models, that they don't have the tools, they don't have the data. It's bias. And let me explain what I mean by this. When you sit down to value a company, bias shows up in so many different places. When you value a company, you almost never value with a clean slate. You bring in your preconceptions, your priors about the company, what you already know about the company into your valuation, and it will affect your valuation. In fact, some of the things you're asked to do in valuation often cut in the direction of more bias. You're asked to find out more about the company, read up what other people have said about the company. As you read those things, it is going to affect your preconceptions, your priors about the company. You're asked to find out more about the management, hang out with them, learn more about them. And God help you, if you start to like the managers of a company, it is going to affect your valuation. And in many valuations, the truth is the value gets set first, the valuation follows. People decide what they want something to be worth, and they try to figure out a way to get to that number. And if you think about the sources of bias, they're both subtle and direct. There's the power of the subconscious, which is if everybody else loves a stock, it's very difficult for you to not love the stock too. The second is we act as if we knew things we never did. It's called hindsight bias, where once we've seen the outcome, we think we knew that was going to happen right from the beginning. There is also the power of suggestion. I've seen people throw a number into a conversation without even thinking about it. And then that number finds its way into your valuation. When you value a company, especially if it's a publicly traded company, this actually shows up in a very obvious way. You value a company, and if it's publicly traded, what's the first number you check? The stock price, right? Whether you like it or not, that stock price will affect your valuation. And finally, there's the power of money. I've told people that once you get paid to do a valuation, all is lost in a sense, because that is going to affect your valuation. No matter how good you are as a person, how honest you are, that money is going to bias the process. I've told people, you tell me who pays you to do a valuation and how much you get paid. I'll tell you which direction the bias is and how much the bias is. And as you add more bias to the process, the less point there is to actually thinking about the inputs into valuation. Now, very quickly though, let me give you some tricks. And these are not tricks that are hidden tricks. We all know it if we've done valuation for a long time. You're doing an intrinsic valuation or a discounted cash flow value for a company. If you want to increase the value of your company, because that's where your bias leads you, we know what you need to do. You take the existing earnings and cash flows and you try to find ways to make them bigger. By doing what? By removing expenses that are really operating expenses, and you call them extraordinary or one-time expenses. By counting income that is one-time income, but you act like it's an ongoing income. Using a low effective tax rate because we were able to pay less in taxes last year. To increase the value of growth, you push up the growth rate in your revenues, you push up your operating margin. That's going to give you a higher income in the future. And and as a companion, you make sure you can do all of this without reinvesting very much. Low capex, low change in working capital. When you think about the discount rate and you think about the inputs, you want to make the discount rate as low as possible if you want to make the value higher. How can you do it? You can replace today's risk-free rate with what you call a normalized rate. A rate much lower than today. That's tough to do in today's interest rate environment, but when interest rates were 5 or 6%, people did this. You can try to act like your stock is a very low risk stock relative to other stocks. If you're talking about betas, you try to give it a low beta. You try to use the lowest equity risk premium you can, and you play tricks. You take a US company that gets 80% of its revenues from Brazil, but you treat it as a US company and give it the equity risk premium for a US company. And even within the US, your biases lead you towards lower numbers. And finally, if you're introducing debt, you add debt into the process without any of its side effects. You increase the debt ratio without affecting the beta or the cost of debt. you lower the discount rate. Finally, in the terminal value, they're all games you can play that can make that number a huge number. You can use a growth rate that's too high, a growth rate much higher than the growth rate of the economy. Mathematically impossible, but it pushes up your value. You play that little game that some analysts play, which is it's a mature company, doesn't have to reinvest any money. No reinvestment but growth. But these are all tricks we play in intrinsic valuation. In pricing, where you try to put a number on a company based on how similar companies are priced out there, you get to pick what companies are similar, and you get to pick what you scale the price to: earnings, book value, revenues. Hey, I've given you choices that you can use to come up with whatever number you want, because you will pick a peer group that reflects your biases, and you will find a pricing metric that works for you. So when you tell me to use those 7 companies in EV to EBITDA, the question I should really be asking is, what did you start with before you came up with 7? And what other pricing multiples did you try before you tried EV to EBITDA? So bias is part of the game. You're probably sitting there saying, right, I'm not biased. Let's play a few what-if questions. Let's say you're valuing your own business and you take the role of the owner of the business. If you're valuing your own business for sale to a third person, do you want the number you come back with to be a high number, a low number, or none, or you're not quite clear? Pick one. I mean, I'll give you my answers at the end, but pick based on the structure I've put on you. You're valuing your own business. What's your bias? You're a venture capitalist investing in the same business. Do you want to attach a high value to the business, a low value, or unclear? And remember, the venture capitalist value will determine how much of your business he's going to ask for you. Because if he puts a high value, he'll ask for a lower percentage. If he puts a low value, he'll ask for a higher percentage. So think about it: high, low, or you're not clear. Let's make it personal. You get married, you get divorced, you own a business jointly. You're valuing your business because half that value has to go to your soon-to-be ex-spouse. Do you want the number to be a high number, a low number, or you're not quite clear? Be honest. If you're an appraiser for the owner valuing a business for tax purposes, remember the value is going to come back and the tax guy is going to take away 30% of the value. Do you want the number to be a high number, a low number? You're not quite clear. But if you're an appraiser for the IRS looking at that same business, you're attaching a value. It's the same company being valued from the other side. Would your bias be high, low, or unclear? Now do you see why courts get so much work in valuation and why you have expert witnesses on both sides? Let's talk about equity research. You're a sell-side equity research analyst. So these are the equity research analysts we read about, work at investment banks, valuing a company with the intent of putting a buy or a sell recommendation. Is your bias to come back with a high number, a low number, or you're not quite clear? Think through the consequences. If you come up with a high number and you put out a buy recommendation, everybody likes you, including the company. And remember, your access to information comes from whom? The company. So think through it. Okay? If you're a buy-side analyst, in other words, you work for Fidelity or Janus, and your portfolio manager is asking you to value a company, and he tells you, oh, by the way, I own 1 million shares of the company. Do you think there might be some bias in your valuation? Are you going to come up with a high value, a low value, or you're not quite clear? Similarly, if you're a buy-side analyst valuing a company and your portfolio manager says, I hate the company, I've sold short 1 million shares of the company. What do you think your bias is going to be? What do you think will make him happy? Because remember, if he's happy, you're going to be happy too. Now let's look at the most biased process of all. Let's talk about M&A. You're an M&A analyst. It's a friendly merger. So you've got an acquiring firm and a target firm. You're an M&A analyst working for the banker of the acquirer in a friendly takeover. Do you want this deal to go through? Think through the consequences. And therefore, do you want the value to be a high number, a low number, or an unclear number? Remember, you want to come up with a number that can justify the deal going through. Now you're the M&A analyst working for the target company. And you want the deal to go through too. Remember that you want the deal to go through no matter which side of the transaction you're working on. Now do you want the value to be a high number, a low number, or you're not quite clear? This is one of the trickiest games to play in valuation, because both sides have to merge thinking they won. So the acquiring company and stockholders have to be convinced that they're getting a good deal, that they're actually buying a company that's worth a lot more than they're paying for it. At the same time, the target company shareholders have to be convinced that they're actually getting a great deal, which means that the price they're getting is higher than the value. You see, how the hell do they pull this off? They do it all the time because these deals go through. And that's where magical words like synergy, and control can come in because they fill in the gap. Finally, let's talk about a hostile takeover. In a hostile takeover, the acquiring company wants a deal to go through, the target company does not. You're the banker for the acquiring company, your game gets a little trickier, right? Because if you come up with a really high value for the target company, well, the target company is going to use that as ammunition to stop the deal. So you might actually reverse what you had with the friendly takeover process. But let's face it, it's biased still because you still have a bias in getting the deal through. So the bottom line is that when you do valuation, acting as if your objective is delusion. The bottom line on bias is it's unavoidable. You know why you have it? Because you're a human being. You're saying, what if I build a machine, a computer to do it for me? Who built the machine? Your biases will find their way into your machines. There is no way you can avoid it. So what can we do about it? Let's stop being in denial. I'm tired of certification groups like the NACWA, ASA, CFA, all claiming to be objective. Let's accept the fact that bias is part of the game. And then let's be transparent. When you do a valuation, let's practice some Bayesian valuation. Bayesian statistics, you state your priors first and then you tell me what your results are. Bayesian valuation, you tell me what your biases are before you show me a valuation. And finally, let's stop lying to ourselves. The person you got to be honest with, especially if your investments are based on evaluation, is yourself. So be honest with yourself about your biases. The bottom line is bias is part of being human. It's not a bad thing. It's not a good thing. It becomes a problem when we act like it's not there, because then we have problematic valuations.